So we'll get started now, and just a quick introduction for new people who don't really know me. So my name is Jasmine, currently based in Toronto, Canada. Just finished my third year, so going into fourth year at Smith School of Business, and am a commerce student there. And also am an incoming summer business analyst at McKinsey. So going to be interning there starting beginning of next month. And then for my second year internship, I did an asset management internship at Burgundy Asset Management. And I'm also doing health e-commerce entrepreneurship on the side as well. Okay, so that's it for introductions. And so today we're going to be talking about, first of all, what you usually see used as a structure framework during cases, and maybe what to kind of avoid. And then going into what I like to use for my case structure frameworks according to the type of case that I get. So we'll be looking at an all-star framework, which is one that I like to apply to almost every case that I get, changing that to suit a profitability case, growth strategy case, a market entry case, an M&A case, and then also build versus buy case. And then also looking at just like non-conventional cases as well. And then at the end, we can wrap up with Q&A. Okay, so just to kind of remind everyone, this is what a typical case interview flow looks like. You have the entire case interview that takes around 20 to 30 minutes. And then structuring is after you get the problem introduction, and then before you actually dive into the bulk of the case. But it's also the most important part, because if you have a good structure, the rest of the case will go well as well, since you always want to go back to your structure. So in terms of generic frameworks, this is what you see a lot of people using regularly. So there's the kind of typical 3 C's, the company, customer, and competition framework. And then sometimes you also add in their product as well. And a lot of people do use this framework, but I feel that it's a bit overused. A lot of interviewers have heard about it, and people always use this. It's a bit predictable, and it's also not that creative. And sometimes you don't really want to force a case into this framework. You want to be more flexible about it. There's also your typical revenue and cost framework that people use for profitability cases. But also, I kind of like to spice it up a bit. I don't just like using these basic frameworks because they may be irrelevant at times, overly simplistic, and then also untailored to the case. So this is what I like to stray away from these typical frameworks. What I like to use is called an all-star framework, that I kind of saw different types of frameworks and then made kind of my own that merges the good parts of each framework. So in no way do you have to use this framework for all your cases. And this isn't, I'm not saying that this is the correct framework to always use, but it's something that you feel free to use if it works for you. And it most certainly worked for me. So basically, for this framework, I have 4 buckets in which I like to kind of use, but also delete parts of the framework as needed. And then throughout the whole structuring process, you want to be able to hypothesize the main factors, highlight potential solutions to the issue that you're trying to solve, and then also point out specific industry insights. So I'll go into what that all kind of means a bit later, but first to start off with the 4 buckets that I like to use for my all-star framework. It's revenue optimization, the cost structure, market outlook, and then strategic considerations and risks. And if you think about this is just split into quantitative analysis and then qualitative analysis, which is what any case will sort of be made up of. You'll see that quite a lot. And so you can split any case into these 2 buckets of quantitative versus qualitative. And then further, I have revenue, cost, market, and then basically an other bucket. But you do want to just word them a bit more creatively. You don't want to just say revenue, cost, market, and then other. This is why I added kind of revenue optimization to spice up the names and to make it seem more creative. So for revenue optimization, you can split that into your typical price and volume. That's totally fine. And then for price, it would be things like looking at supply shocks or shortages, if that is applicable. Of course, any of these subpoints, only mention them if they're actually relevant to the case. This is just a master list of everything that I could possibly think of, in which some could be relevant to the case that you're dealing with. So another thing under price is the consumer's willingness to pay. So this is dependent on the number of alternatives available, the firm's pricing and branding power, and then also the firm's positioning. Are they high end or low end? And how are they able to differentiate themselves relative to other competitors? On the volume side, you have production capacity and utilization. So how much the firm is actually able to produce. And then out of the production plants or facilities that it has, how much is actually being utilized? Is it underutilized or overutilized? And then also maybe the number of customers. So looking at retention rate, acquisition rate, how many old versus new customers are you gaining every month or every year? And then looking at the client mix, what sort of customers are you dealing with or do you serve? And then what is their order frequency? You also want to look at your product mix. So what can be done to your product market fit to make it fit the customer's purchasing criteria, and then of course differentiation ability relative to other products on the market. And are there any upsell, bundling, or additional service opportunities in which you can use to increase your volume of this revenue bucket? And then of course there's also marketing and distribution intensity or efforts. So could you do partnerships, loyalty programs, or other things to increase marketing and distribution? So those are all the possible things that I can think of that I can talk about in this revenue bucket. And then for your cost bucket or your cost structure bucket, it's totally fine to just do fixed costs and variable costs. You don't have to be too creative in your sub buckets, as long as your main buckets and then also the content within your buckets are creative. You can just do fixed costs and variable costs. So for fixed costs, again, I like to list all the possible fixed costs that there are pertaining to any sort of typical business, and then same with variable costs. And as long as I have that list and I'm familiar with that, any case I can pull out all the relevant fixed and variable costs. So for fixed costs, you would be looking at things like plants, production plants, real estate, stores. A solution to reducing costs in that aspect could be consolidation. And then also your CapEx depreciation. to reduce those costs. Maybe you can lease instead of actually owning those costs. There's also R&D and licensing, and those could actually act as a barrier to entry into the market for other new competitors. So notice these bolded things. These were the things that I talked about before of hypothesizing main factors, highlighting potential solutions, and then pointing out specific industry insights. So all these bolded points. So for example, consolidation, that is a potential solution to high costs. Also that leasing too. And then barrier to entry, that's something that you can touch upon as you're going through your structure and saying, oh, well, the real estate industry, for example, is one that has high capex or high kind of investment and upfront investments. And those act as a barrier to new competitors that are trying to enter the market. So you can touch upon those specific industry insights as you go through your structure, and that will add depth to your entire structure as well. And then you also have your, sorry, let me look at the chat for a second. Yes, all this will be recorded and it'll be available in a couple of days. So yeah, for fixed costs, you also have like software and system costs as well. If it's a software company, you have overhead and maybe disposal or waste costs. This is maybe applicable to like grocery chains or stores and businesses that deal with those type of waste. So for example, a solution could be to increase efficiency using automation or ERPs. And then for marketing, could you maybe outsource those costs? There's also service fees, trade spend, that's relating to, for example, if you're a manufacturer and then you're trying to let retailers sell your products, and there will be service fees and trade spend fees. And so that will relate to the upstream and downstream contracts that you have in place and the relationships there. And then also there's insurance costs. So those are all the major fixed costs for any sort of business. For variable costs, you have things like labor and commission. This is quasi-variable because even though you could technically fire all your employees, there will be severance costs if you choose to do so. So that's why it's quasi-variable, since there is a fixed component to it. There's also raw material costs. To reduce this, maybe you could hedge against raw materials. A lot of financial institutions, they do this. And then vertical integration as well. If you currently outsource raw materials, maybe you want to do that in-house instead. And then you can also import raw materials at a cheaper price. There's also maintenance costs. Again, outsourcing is a possibility. And then distribution costs. So solutions could be maybe to implement an omni-channel and then again to outsource. So those are all the major variable costs as well. And then for market outlook, I like to split this into 4 different sub-buckets, which are size and growth, market share, consumer trends, and supply chain. The first 3 are actually the most important. Sometimes supply chain may or may not be relevant. So depending on the case, you may or may not include it. So for size and growth, that is looking at the current size of the market, but then also what is the potential size in the future and how fast it will grow. So this is dependent on macro factors such as unemployment, recession, cyclicality within the industry, and the overall bigger economy. You also have industry growth factors that are specific to the industry. And this is where you can, again, highlight those industry specific insights. So maybe it's e-commerce, or maybe it's population growth, or some sort of trend or growth in other related industries that is causing this industry to grow. You can also look at disruption. So automation, technology, AI, is there something that's coming into the field that is actually causing this industry to shrink and is a threat to this industry? And then the next sub bucket is market share. So looking at how concentrated this market is and what is the consolidation trend of major competitors. Also looking at barriers to entry and new entrants, and then regulation as well, all relating to market share. The third sub bucket is consumer trends. So adoption rates and preferences of consumers. What are consumers preferring and interested in? And then specific consumer segments that are growing. So for example, within the apparel industry, maybe the swimwear apparel section is growing the most, or maybe the high end is growing more than the low end. These are all valid points to bring up according to your case. And then supply chain is simply how are the dynamics of the supply chain within this industry? So in the upstream and downstream relations, where does the power and leverage lie? Is it manufacturers are the most powerful in this industry, or is it retailers are more powerful? And so that could indicate how big this market is or how attractive this market is. And then the last bucket for this all-star framework is actually my favorite bucket, because it's almost like a bucket that if you don't know where to fit some of your points, they don't really fit into any of the other buckets. You can just put them into this bucket called strategic considerations and risks. And that is just a fancy word for saying everything else that I can't really think of another bucket to put it in. But it's very important, because in this bucket, you can touch on key qualitative factors relating to your structure. So I like to split it into 3 sub buckets. Number 1 is expertise and core competencies. Number 2 is alignment with core business. And then number 3 is risks. So for the first one, expertise and core competencies, this is relating to what is your client or this company actually good at? And does it have the ability to execute on whatever this case is asking it to execute on? So things like manufacturing abilities, how many plants does it actually have? And then distribution, does it have the pre-existing networks available, or does it have to build out new ones? Does it have employees available and training available? And then what are its marketing capacities and abilities? And most importantly, what is it planning to do? Is it planning to outsource all of these capabilities if it doesn't have them in-house? And then also, are they planning to do these things through a greenfield venture or an acquisition or a joint venture? So does it want to do it by itself from scratch, which is a greenfield venture, or is it going to partner with other firms with those capabilities? The second one is talking about the alignment of whatever this case is talking about with the client's core business and goals. So will whatever, maybe it's a market expansion case, or it's whether or not to sell a new product, or whether or not to do something. Does this align with the current brand? Is it value add or is it value loss? What are the synergies between this new thing or business that the client wants to do versus their pre-existing businesses? And then the strategic importance. So what is this on a priority scale for the client? What's the ability to scale this entire operation? And then what are the opportunity costs? Are there maybe more attractive ventures that the client should look at instead of focusing on whatever they're trying to achieve in this case? And then, of course, another important thing is risks. So if it's a new product or a new market, what's the cannibalization risk? Are there regulations that need to be followed, and is it risky? Are there integration risks and difficulties? Will this divert management focus from their core businesses or other more important priorities? And then also, will this lead to intensified competition? So those are key qualitative factors. There might not be a specific number or cost or revenue figure relating to these points, but they're still important as qualitative analysis. So that is the all-star framework that I like to use. And then we'll go through kind of specific cases and how this all-star framework applies to those cases. And as I go through the specific cases, you can notice how I kind of change this all-star framework up. But throughout the whole thing, I do tend to use this as a starting point. Okay, so first of all is profitability cases. This is the most common case that you'll probably run into. It's about finding and solving the root cause of decreasing profits. And so this is the structure, a bit changed from the all-star structure that I like to use. So I only have 3 buckets for this. I have revenue optimization, cost structure, and then market outlook. So I got rid of the strategic risks and considerations just because it's not too relevant to a profitability case, because you're not trying to decide whether or not to do a new product or a new venture, but rather you're trying to find out what's causing decreasing profits and try and solve it. So these 3 buckets are all relevant to that, because profit issues, it could be a revenue issue, a cost issue, or it could be because of the overall bigger market environment. So for market outlook, one thing to note is that I kind of like to start from market and then go to costs and then go to revenues last. And I like to do that in that order because usually it's not a market problem. Because for decreasing profits, if it was a market issue, a lot of the times the case would end there, because it would say, oh, the entire economy or the entire market is shrinking. Hence, that is causing profits to decrease. And there's nothing really that you can do about it at that point. So most often it is a revenue or cost issue, but you do want to cross this out at the start. So even though it probably isn't a market issue, you want to make sure right off the bat so that you can cross that off your structure and say, okay, so we know that this isn't a market related issue. The next thing I want to look at, we can cross that off our structure, like actually cross it off. That will show that you're actually going back to your framework, and then say, then I want to move on to cost structure and see if decreasing profits is because of costs. And cost is more simple than revenue, because if it's because of high fixed and variable costs, you can usually find that out pretty quickly and then try and target the issue. But then revenue is the most complex, since there's so many moving parts to revenue. It could be because of price, it could be because of volume. So you want to save that until last, so that you can cross out the more simpler things first. Okay, so that is a profitability case. The next is a growth strategy case. So this is a case where you're identifying ways to expand and grow revenue. So oftentimes you will have a target revenue dollar amount that the client is trying to achieve. And your goal or your job is to find ways to actually achieve that target revenue dollar amount or growth amount. And so this is the framework that I like to use. It's market growth, optimize existing revenue, and then new sources of revenue. So I kind of only, from my all-star framework, I got rid of costs because costs isn't relevant isn't really relevant to a growth strategy case. You're not really particularly concerned about profits so much or about costs. You're just focused on hitting revenue growth. So that's why I have two buckets that focus on revenue and then also the market growth as well. So for this case, you can also think of it like organic growth and then inorganic growth. So organic growth, the first bucket, market growth, is talking about the natural growth that your firm will achieve by maintaining market share in a growing market. So if this is a growing market, even if you still maintain 10% market share, your overall revenue is still going to grow along with the market. This bucket is talking about that. So you want to analyze the size and growth of the market, market share, consumer trends, and supply chain. Same thing as we talked about in the All-Star framework and any kind of market growth or market related bucket. The other bucket pertaining to organic growth is existing revenue. So of your existing revenue, how can we better optimize that to increase it? Again, price versus volume. Same thing as what we talked about before in any revenue bucket. This new bucket is inorganic growth or new sources of revenue. So instead of just looking at, price and volume for your existing revenue, this is looking at new ways to expand. So three things that you can look at here: expansion into adjacent markets. So for example, if you're in the grocery market, looking to expand into the fast food market, or into the convenience store and gas station market. So looking at the attractiveness of those markets, the ease of expanding into those markets, and then the alignment of those markets with the current industry that the firm is in. Second thing is geographical expansion. So same industry, but maybe if you're a North American company, you want to expand into the Asia Pacific region. Same thing, attractiveness, capacity, expertise of doing so, and then the risks. And then the last thing is M&A, so mergers and acquisitions. Instead of growing organically, can we acquire or merge with a similar or synergistic firm? Of course, you want to look at the accretion and dilution of a potential M&A, and then the synergies or integration difficulties with that inorganic growth. So this is for growth strategy. This type of case is market entry, go or no go. So this is evaluating whether or not to expand into a new market. And for this type of case, I like to use 4 buckets: competitive strength, costs required, market attractiveness, and strategic considerations and risks. And you might have already realized, but this is essentially identical to the All-Star framework that I mentioned at the start, except I just tweaked the names, especially for revenue and costs a bit. So instead of saying revenue or revenue optimization, I named this bucket competitive strength, just because that's a bit more relevant to what you're actually trying to assess here. And then costs, market attractiveness, strategic considerations, and risk, those names remain more or less the same. So for this one, the sub buckets are more or less the same throughout. For costs, you're looking at fixed costs. Are there any large upfront costs required? And then for variable costs, the main question that you're asking is it cheaper in these new markets comparatively to what we're already achieving in our current market? And then the rest is the same. Okay, The next type of case is merger and acquisition cases. So whether or not to merge with or acquire another company. And for this type of case, it's, I think, probably the most different from the All-Star framework, just because this is a more specific type of case. So you will have to use a more specific or tailored framework. So you still have market attractiveness. Same thing with that, nothing changes there. But then instead of your traditional revenue and cost bucket, you have due diligence of the company that you're trying to acquire, and then the mechanics and risks. Mechanics and risks is similar to the other strategic considerations and risks buckets. So for due diligence of company, you want to look at three things: financial health of the company, moats or competitive advantages, and then management. So for financial health, I like to look at historic revenue, profit, and margins. How have those numbers trended in the past, and how are they likely to trend in the future? Also looking at cost structure and effectiveness of the bucket, or the efficiency of the business. And then also looking at the balance sheet strength. So is this company we're looking to acquire, do they have a lot of debt, a lot of assets, strong and healthy cash flows? So those are all pertaining to financial health. And then you also have moats and competitive advantages. So what moats does this business have? How is it differentiated from other competitors? What is the brand value proposition positioning? And what are the drivers of growth? And does it have any expansion plans that will make this investment worthwhile going forward? And then also management is also very important. How well are they able to execute? What is their execution and capital allocation track record? And then for mechanics and risks, I split it again into three sub-buckets. Mechanics, which is funding, where that money is going to come from, ownership post-merger, and also changes to management. Is the current management going to remain in control, or are we going in and changing and directly managing this new company that we acquire? Future plans and exit strategy. How long are we planning to hold on to this company? And do we want to sell it after a set period of time? And then accretion and dilution analysis. So the purchase price versus the valuation. Are we overpaying, or is this a good deal? What are the revenue synergies that we can obtain, increase customer base, cross-selling, etc.? What are the cost synergies, labor, overhead, consolidation of resources or real estate? And then risks. So integration difficulties, is there going to be reduced efficiency of merging the two entities? And then cultural, administrative, economic distances. So this new company we're trying to acquire, are there differences in consumer preferences and regulations if it's a company in another country? So this is for M&A type cases. The last type of case is build versus buy. So sometimes you might get a specific case in which you have to decide whether to build something in-house or buy it through outsourcing. So this could be a new technology that you're trying to develop, or a new software or service or platform, whether to do this in-house or outsource it. And so for this, you have basically just another version, changing up the names a bit and the content a bit of the All-Star framework. So once again, you have revenue, so impact on revenue. You have costs, so costs and time. And then instead of market, because market isn't too relevant in this case, I replaced the market bucket with strategic importance and then capabilities and risks. So impact on revenue, you're looking at, okay, so if we build this thing, how much revenue will we be able to make? Are we able to pass on cost savings to customers by doing this in-house? And then because the price comes down for customers, that will increase the volume that we will be able to solve. If we buy it or outsource it, what's the revenue that we'll actually be missing out on? For costs and time, it's of course the costs of setting up the plant, setting up the in-house facilities to actually make this thing, versus just paying a service fee or a royalty fee to outsource manufacturers or the contract fees. For time, it's the time lag that we'll have to deal with if we do this in-house versus the immediate service or product that we can use if we outsource. And then the opportunity costs, so future revenue opportunities, and severance costs if we do choose to outsource. This is relevant if we are already making this in-house and then we're choosing to outsource. We would have to lay off the employees or the teams that are relevant to this current in-house service. For strategic importance, that's addressing risks of price increases from suppliers. So if we have low bargaining power, maybe it's better to do this in-house so that we don't have to keep on relying on suppliers. And then differentiator or value to customers. So to customers, how important is it that we outsource versus if we have this in-house? Strategic flexibility. Are we able to use this for other products and services if we do this in-house? And then we can unlock additional revenue streams that way. There's also the commercialization of potential and ability. So ability to scale this new in-house service that we make and sell it to other competitors as well. And then the last bucket is capabilities and risks. So for our capabilities, do we actually have the ability to do this in-house? So scaling and training required workers. And what's the success rate of being able to actually make this in-house? Or how able are we to find suppliers instead? And then the risks is obviously the ease of integration. If we do outsource it, maybe it's not too easy to integrate it with our services. And then the maintenance required if we do it in-house, and also regulations and licenses that we would have to obtain if we were to do this in-house. So that is build versus buy. And the last type of case that I just want to touch upon is just non-conventional cases. So sometimes you will get a case that doesn't deal with revenue or profits. And sometimes those type of cases can kind of throw you off because you can't really use your traditional revenue and costs or profitability case buckets because there are no revenue numbers or profit numbers that you're dealing with. So an example of a case like this is, for example, public sector cases where maybe the case is the number of healthy people in this country are declining, and your client wants you to find out why that is and how to fix it. So notice how there's no revenue or profit numbers associated with a case like this. And so you can't really use your price and volume sub-buckets and revenue buckets in this case. So for these type of non-conventional cases, I like to just simplify it fully and use internal and external for my buckets, or sometimes supply and demand is more relevant. They're essentially the same thing because using this case as an example, the number of healthy people are declining. For internal and supply, you can look at capabilities and capacity and distribution. So why are the number of healthy people declining? Maybe it's because in this country, we don't have enough capabilities. How much expertise do we have in terms of these health sectors or research into certain diseases? How many facilities and supply of nurses or doctors or health facilities do we have? And then for distribution, you would be looking at, okay, so the nearest hospital, how near is that for access in terms of proximity to neighborhoods and people? Are these mandatory services, or are they just according to if you get sick, you go, but if you don't get sick, you don't have to go for checkups? And then how regulated is kind of the entire healthcare industry? On the external and demand bucket, you could look at the macro environment. So disposable income, is it because people don't have money to actually seek treatment? And a solution would be maybe subsidies from the government. Awareness, how good is public education, promotion efforts to spread the awareness of the importance of health? Substitutes or alternatives that people are turning towards rather than regular checkups or doctor appointments. And disruption. So is it because there's a current outbreak of a disease or an infection that is causing this? Or external trends, more and more people are becoming obese, unhealthy eating habits, etc. So that is how I would deal with a non-conventional case like that. Okay, so that is about it. Just to wrap up, this is again the all-star framework that I have been using all throughout any type of case. Just to recap, you can think of it being split into quantitative analysis and qualitative analysis. And then your 4 main buckets, which revenue and costs, I usually almost always keep, because it's usually relevant to majority of cases that deal with profits or money or revenue. And then for qualitative analysis, sometimes both market and strategic risks and considerations are relevant, but sometimes I use one or the other if they're not too relevant to the case at hand. Okay, so that is about it. We can wrap up with questions if anyone has any questions.